In the sense of Bitcoin, I would actually say that the fact that it's so difficult to change it is pretty much one of its biggest strengths, if not the key strength, because that makes its characteristics, like the 21 million coin limit, actually real. Because in Bitcoin, we can't even agree to increase the block size from 1 to 2 megabytes, I think you can pretty reasonably expect that it will be impossible to actually change that 21 million coin limit.
Hello, welcome to episode 62 of the Bitcoin Game. I'm Rob Mitchell. Michel Rauchs is the cryptocurrency and blockchain lead at the Cambridge Center for Alternative Finance. For the past few years, Michel has devoted his life to studying the space, and he's been a big part of several comprehensive studies digging into many aspects of Bitcoin and other cryptocurrencies. You'll see Michel and his reports cited in tons of articles, particularly those that focus on Bitcoin's energy use. I hope you enjoy episode 62 of the Bitcoin Game with Michel Rauchs.
Hi, Rob.
Hi, Michel. Welcome to the Bitcoin Game. Before we get into all the Bitcoin stuff, I was just curious if you'd like to share some of your background. You were from Luxembourg, is that correct?
Yeah, so I grew up in Luxembourg. That's where I'm from, speaking the language, which actually does exist, although only around, 300,000-400,000 people can actually speak it. Mm-hmm. And then, yeah, because it's really, really small, it kind of like gets boring pretty quickly. So I decided to go study abroad. So I went to study economics in Switzerland. And then after that, I went for a gap year in Barcelona, where I learned Spanish as well. And so I've always been really interested in financial markets, monetary systems, and so on. So, and I tried to make sense of what was happening in the markets. So I was reading every morning the newspapers and couldn't really make any sense out of it. The same events had always different explanations. So I was really looking forward to starting economics and finally have somebody tell me how things essentially work. Now, this turned out to not necessarily be the case. If you go and study economics, generally in most economic departments, you just get to see one particular school of thought, so mostly neoclassical economics. And funnily enough, when I started in 2011, that was really in the middle of the economic crisis or worldwide crisis. So essentially, the models didn't make any sense. So you had a certain output, then input, certain complicated mathematical model, and the output was exactly the opposite of what was happening in the real world, which of course made you question these models. And then, so I dug a little bit deeper and found out that actually there's not one science of economics, but there's hundreds of different schools of economic thought, as we like to call them. And that really got me interested in digging a bit deeper about financial systems and then necessarily also monetary systems. When I found out about Bitcoin, I think it was around the second time. So like everybody else, first time, didn't really pay much attention, forgot it for 1 or 2 years. But then since my interest really turned into these monetary systems, the second time I heard it was end of 2013. It immediately clicked. And then I decided really I want to spend the rest of my research essentially just on Bitcoin. And that's pretty much how it started. So I went to business school after that for a year. And then the second year, instead of doing an internship, I essentially decided to spend an entire year researching the Bitcoin ecosystem. And so I did a master thesis on the evolution of that ecosystem. So I collected data from, I think it was around 600 projects in the space, primarily companies, and then visualized essentially the structure of the ecosystem over time. So from 2010 to 2015 included.
When you research all these projects, how do you go about that?
So now, since I work for the Cambridge Center for Alternative Finance, of course, the, let's say, modus operandi has changed quite a bit. So for my master thesis, it was literally sitting down for 12 hours a day for 3 months in a row, just browsing through, obscure forums, Reddit threads, Twitter threads, and literally anything I could find to get information about darknet markets and other types of actors that actually had already disappeared by then. So that was really some heavy desktop research. For the work that we do with the center, we've got a lot of contributors from all over the world that help us distribute surveys. So essentially now we reach out directly to companies and actors in the space, something I couldn't really do as well as a student. Mm-hmm. So I have to say the Cambridge name helps pretty well with that. So actually we really see lots of companies, especially also in the crypto space, that are very open about sharing data. because they really want to be put on the map, essentially. And also they see it as a way of showing that they are, complying with existing regulations and so on, and not playing against the rules as is often portrayed in the media. So I've been surprised a bit by that.
How long has the Cambridge Center for Alternative Finance been around?
So the center was essentially founded in early 2015. And so initially the main focus was really on crowdfunding, peer-to-peer lending. And then just when I published my master thesis, so I didn't really know what to do after that. So I essentially cold emailed someone who was working there back then. And I immediately got a job there to continue doing this kind of research. So that was the year, so that was 2016, if I'm not mistaken, where essentially they decided to expand their research to also cover cryptocurrencies and blockchain. So by blockchain meaning enterprise blockchains.
The main thing I was really interested to talk to you about is Bitcoin's energy use. It's a hotly debated topic.
I think it's been one of the key criticisms that has always been coming back. So that Bitcoin and other proof of work cryptocurrencies, that they would waste energy. Essentially, well, why I'm using the term waste, because that energy, according to those critics, doesn't really serve any useful purpose or related to the computations that Bitcoin miners do. And now the thing is, that might actually be true or not. It's really difficult to tell, because for that we would need to do a cost benefit analysis, right? So try first to estimate the benefits derived from using Bitcoin, and then also estimating the costs. And actually to do either is actually really, really difficult to get those metrics. So going back to the costs, so what we can do, there's different ways of actually estimating how much energy is being used to generate Bitcoin's proof of work. Now, of course, it's dynamic, and there's lots of assumptions in these models, but actually the best one we could find is from Mark Bevent, who had a pretty decent methodology. So essentially, there's no way of exactly pinpointing it down. So what you do is you try to get a range, so a lower bound and an upper bound, and then you use assumptions to calculate both of these bounds rather than one precise value. For the lower bound, it's actually pretty easy to do that because you actually just take the most efficient hardware on the market, and you actually just assume that every miner is running the most efficient hardware in the most efficiently possible way. So in the most efficient data centers, everything top notch. So when you do that, you get to a certain figure. I haven't actually done so I haven't updated the model, so I couldn't tell you how much exactly it is right now. So the reason actually we started looking at this as part of our report, so our report is really a general overview of the ecosystem. And so mining is just, let's say, a rather tiny part of all of this. But the reason we really wanted this time to focus more on the energy consumption is really because lots of criticism have come up. And we actually think that some of these, at least, kind of like mix different concepts up or make claims that are not really supported by any evidence. So we wanted to have a more detailed analysis on that. The first step is, of course, to try to estimate the energy consumption. And so for the lower bound, that's kind of like a general heuristic, essentially, that has been used by lots of different people. You just assume that everybody's using the most efficient hardware in top data centers. So when you do that, you get 52 terawatt hours of energy a year if you combine the top 6 crypto asset networks. So that would be Bitcoin, Bitcoin Cash, or, well, that was back then, Bitcoin Cash actually didn't fork. They've got Ethereum, Litecoin, Monero, and Zcash. So that would be around 52 terawatt hours.
What was the date of this?
That was as of mid-November. So that was already when market cap of all cryptocurrencies had declined significantly, but actually the hash rate was still constantly going up.
Right.
So we could notice like a big lag in between those two. So essentially, I think it took just after, it was around December, beginning of December, where you can really see the hash rate started going down. And now I think we're back at pretty much the same levels again. And of course, energy consumption, as a result of that also, either surges or goes down. But so for the lower band, it's not actually really difficult to do that. Pretty much anyone can really very easily calculate that. But the problem is just it's very unrealistic assumption. So the lower bound is never really the true energy usage. So where it gets interesting is then, okay, so how could we actually calculate the upper bound without being utterly unrealistic either? So, for example, one thing you could do is say, well, what if everybody mined Bitcoin using a CPU? And then you would actually get to a number that would be so large that essentially it would consume more energy than exists on the entire planet or the universe, I think. I'm not exactly sure anymore. Well, it's just a ridiculous amount of energy or number.
Right.
So that is also a pretty bad assumption. So you need to kind of like cut it back a little bit. And that's where we found Mark Bevans, who came up with a very good analysis on how to calculate that upper bound. And so the idea is, we assume that miners will always mine with the least efficient hardware that's available, as long as the hardware itself, just using electricity costs, is still profitable.
Good.
You don't use any hardware costs. You don't take into account any, other things. You essentially just first have to model for each mining hardware, so for each old ASIC, for example, in the case of Bitcoin, how long you could essentially operate that using the given the actual hash rate, until it wouldn't be profitable anymore if you just consider electricity costs. And then you add to that all the, network or data center assumptions. So there's different things like the PUE and so on about how efficiently a data center is essentially run. So how much energy goes into cooling machines rather than essentially powering the machines. And so there's different assumptions you can do for that as well. So once you tweak a little bit the model, you actually get then to an upper bound, at least as of mid-November last year, of 111 terawatt hours for the 6 top cryptocurrencies.
So just over twice the lower bound.
Exactly. So you've got a range between 52 and 111, which is quite a lot. So you could probably say that, given that some miners are mining rather inefficiently, but because the electricity they use is pretty much free, you have to take those into account. But then on the other hand, you have also miners that really do it on industrial scale with the most modern data centers available. And then you could say that, well, if you take the midpoint of that might actually be a rather realistic estimate. So the midpoint of this would be around 82 terawatt hours. And then is the point. So once you've established that, you've got like kind of an idea, okay, so how much energy do actually these crypto assets or cryptocurrencies consume? And just keep in mind that this was really in mid-November when the hash rate was really at all-time high levels, which has changed a little bit since then. And as a result, the energy consumption has also gone down. But then the thing is, usually then that number, and it's often not the midpoint that gets used in these estimates, but often then they just take the upper bound. And then it said, okay, now Bitcoin uses as much energy as, in this case, the midpoint would be equivalent to the energy consumed in one single year by the entire country of Belgium, which then sounds like it's really a lot. The thing is, you can actually make it look small as well. So, for example, we tried to look for another comparison. And so what we found is that 82 terawatt hours is actually less than 0.01% of the world's total annual energy production, or also the equivalent of all the electricity that's generated alone in Germany by biomass and solar energy. The main question after that then becomes, well, is it worth it? And of course, most people don't think it's worth it because they consider Bitcoin to be completely useless. Again, to do an analysis, a decent cost-benefit analysis, you would need to also then estimate the benefits that people actually get from using Bitcoin. And that is where it gets really complicated because there's absolutely no way to find that out.
No one would ever agree on is it worth it? It depends on what your values are, I guess. Were you able to get any data from actually like large scale mining companies, or are they pretty private with that stuff?
It really depends. So some are rather open, let's say. And actually, so what we generally do with our studies is that we combine the survey data we get, and we combine that with publicly available data sources, because there's really an enormous amount of data publicly available, really out in the open. And it's just nobody really takes it and then kind of like repurposes it to do some analysis. So what we generally do is we combine those together, which then gives us pretty interesting estimates. So what we did in our last report is that we came up with a mining map, which essentially shows a distribution of what we call hashing facilities. So these are the big data centers that are hosting all these Bitcoin mining hardware and mining machines. And so we essentially managed to identify more than 120 different facilities that have a certain size, and that are distributed all across the world. Yeah, I'm happy to actually send you a link, also that you can then, link in the show notes.
Great.
This particular mining part that we've just been discussing was just like one tiny part of a 120-page report. So it's just like really one rather small piece of analysis. But I think it was the first time that somebody actually tried to get empirical data on these hashing facilities to then make an informed, estimate about first the energy consumption itself, and then something we haven't really talked about yet, which is the actual impact or environmental impact of that energy consumption. Because so far there's been like lots of opinions and well, let's say, very strongly held opinions by so-called thought leaders and different people in the community, but also from traditional media, or even regulators and policymakers. And everybody has really strong opinions on mining. But the problem is most can't really support those opinions with facts. And so that's why we try to change by actually reaching out to the mining companies, those that operate the hashing facilities, and try to combine that with as much reliable public data that we could find. And so that's how this entire mining map emerged. And as a result, also our attempt to estimate the actual footprint of that energy consumption. Because that's then the next problem that we often see, often in the media, frankly, saying that, Bitcoin consumes as much energy. So all of that energy results also in, carbon dioxide emissions. And of course, increases carbon footprint enormously. And the problem is not all energy is created equally, right? One has an equal footprint on the environment. So if you burn coal to generate 1 kilowatt hour of energy, that has a definitely a different environmental footprint than if you actually use 1 kilowatt hour produced by hydroelectricity, for example. So in order to essentially estimate the footprint of Bitcoin mining on the environment, you actually first need to have a look at the energy sources that went into actually into producing those hashes. And that is something that has been completely missing from most analyses so far. So I know that CoinShares, they did a report where they tried actually to answer that question, and they came up with a number. I think it was around 78% of Bitcoin mining would be running on renewables. It was a very interesting study. They had some good assumptions. But when we saw that number, that was in the middle of our own analyses, we were like, that seems a little bit large. From our analysis, by actually looking at those 120 plus hashing facilities that we found, the picture looked a bit different. We actually tried to identify the energy sources that went into generating the hashes. And so if you look at the share of renewable energy in the energy mix, 56% actually were running on renewables to some extent. It doesn't really tell us how much. Some of these companies run 100% on hydroelectricity, whereas others may have, through the contracts that they have with suppliers, maybe like 1, 2, or 3% of some renewables, that went into that. So the thing is, the only thing we can really say is that 56% of all identified hashing facilities have some share of renewables in their operations in the energy mix. And then we can just verify that by actually looking at the total number of mining farms or hashing facilities that we found, and we get pretty much a similar picture, which means that really the amount of megawatts per facility doesn't really change much there. When we just look at the number of farms, it's 60% where the energy mix includes some share of renewables. Now, it doesn't tell us how much they use. So some of the companies that we surveyed, they actually provided some numbers. So we ran those figures. And so what we could find is that on average, the identified facilities draw around 28% of the energy requirements from renewables. And again, we're probably missing quite a few hashing facilities, so we don't claim that we've actually built a comprehensive map. But yeah, according to our estimates, it's rather 28% rather than 78%, which is quite a big difference.
Yeah, 78% sounds a lot nicer.
You also have to say, well, renewables is not necessarily renewables, right? So there's different footprints for each type of renewable energy. So you can have hydro, which actually has, and depending on where you build it, a rather good footprint. But then you have, for example, solar energy, where it costs so much in producing these solar panels. So cost in the sense of environmental externalities, that the actual effect of running these solar panels is also questionable over the long term, depending on where you do it.
So you're talking energy in general, solar energy, not just for mining?
No, in general. So all I want to say is that even if, let's say, 78% of Bitcoin mining would run completely on renewables, that still wouldn't necessarily say that there is zero impact or zero emissions, right? The thing is, it's not because it's green energy that it doesn't have any impact on the environment either. So the problem is this is a very complex issue in general, and that goes way beyond Bitcoin mining or cryptocurrency mining as a whole. So this is more about, a general discussion about, are renewables really that magic bullets, or are they just like one partial solution to the problem?
What happens if or when the price of Bitcoin goes up? I mean, if the hash power just keeps increasing like it generally has, I worry about a future where a really significant percentage of energy use goes to mining Bitcoin on the planet. Have you done any projecting?
No. For the simple reason is that if you actually do these projections, and it's kind of like exactly the thing that we criticized for some other studies, and the problem is they take the trajectory of the last, let's say, 4 or 5 years, where hash rate has indeed grown exponentially, at least for Bitcoin, and then they project that. But according to their projections, then in like less than 10 years, the Bitcoin mining would consume more energy than the entire world even produces, right? So these extrapolations, they don't really work very well over the long term, which is why we don't really want to get into that.
Why do you think, as someone who studied economics, just an entire system that's kind of based on generating money from electricity?
There's some economic theories that actually say that all is based, of course, on energy, right? And so this is the fundamental currency, essentially, of the earth or the universe, whatever you want to call it. And as such, it does actually make quite a lot of sense. Now, of course, there's more efficient ways to build a monetary system than actually really requiring to burn lots of electricity. For example, the fiat monetary system is actually a really, really efficient system. Now, you might disagree with how it works and so on, but you can't really deny that it's a highly efficient system when it comes to creating money. But so Bitcoin in that regard is really interesting. And I don't really see it that much as money, so money in the sense of like currency, but rather as a commodity that requires a certain effort in order to get minted. So in the case of Bitcoin, we have that, or proof of work currencies, we have it with, proof of work. And that is something that's really fascinating to see.
Did your idea of Bitcoin as a commodity rather than a currency evolve over time, or did you see it that way pretty early on?
I think Bitcoin is actually lots of different things, and it has always been. It's just that some of the uses of it, so whether you can use it as a currency, as a payment method, as a commodity, long-term store of value, just a payment system, I think it's always been all of that. But it's just that at certain phases, some of those uses have been more popular than others and kind of like determined the narrative of what Bitcoin actually is. So when fees were really low, not many people were really using it, and there was a general excitement about, we have a new currency, so the new currency native to the internet, and you had all these new payment processors that were popping up and signing deals with shops and so on. So there was a general excitement that, Bitcoin is really about, a new payment method for cross-border payments, remittances, consumer payments. Then prices started skyrocketing, so more people got in, and then we quickly realized that, these systems don't scale very well, and as a result, fees are rising, which then crowds out lots of these other use cases. And then the narrative changed to focus on, but it's never really been intended as, a currency or to do these kind of uses there, but it's actually always been about having sound money or a sort of digital commodity that is not controlled by some sort of nation state or any entity or corporation. I still think you can use it for all of these different uses. It just depends on your own context. And this is, again, to go back to what we said in the beginning, that it's so difficult to actually try to estimate the overall, utility or benefits that Bitcoin brings to the world. It's just because the utility derived from using it is entirely contextual. So I would say it really depends completely on an individual situation. And this is very, very difficult to generalize. And for each of those situations, there's a different motivation to use it for something different. In my opinion, this is actually the main beauty of Bitcoin. Bitcoin as a system doesn't really care what you use it for, as long as you follow some very simple rules. There's also nobody who can prevent you from using it the way you like. And the problem is with that is that, in my opinion, as blockchains will get more expensive to use, especially Bitcoin. So that's, again, another thing that blockchains, or at least public blockchains, where you don't really engage in trade-offs to boost performance at the expense of security. In those blockchains, the problem is that the more popular they get, the more expensive and unusable they become. So essentially, public blockchains become victims of their own success, just because if everybody wants to use them, they effectively become unusable. Just because fees rise, there's not enough block space to accommodate all transactions. And as a result of that, and this is just if we assume that there won't be some magic breakthrough with some new consensus algorithm that ticks all the boxes without having to engage in any trade-offs. So kind of like fairy tale things. So I don't really believe in that. But let's assume for a second if it did, then of course that wouldn't be a problem. But since that's not very realistic, so all things equal from this particular point in time, then blockchains will necessarily become more expensive to use. And this will drive out all of these use cases where right now Bitcoin is the most efficient or best alternative for people, because Bitcoin will get so expensive to use over time that it won't be the best alternative anymore. If you really want to keep Bitcoin the way it is, so the most trust minimized possible, then I don't think you can really focus on trying to have it as the best alternative compared to other consumer payment systems or cross-border payment systems. And then we get to the second category of use cases, which I think are the most interesting in the sense that this is really what cryptocurrencies have been designed in the first place. And that is enable users to do things that others wouldn't let them do or allow them to do. And so that's what some people call censorship resistance. So that's really do the payments in the case of Bitcoin that you otherwise couldn't do, in the sense that somebody would prevent you from doing it or not allow you from doing that. And so this could be, circumventing capital controls. It could be sending money offshore somewhere, but there's also lots of legitimate use cases as well. So it really depends. But I really think that this is the main value proposition of cryptocurrencies. And that should be really the one value proposition that we should try to preserve at all costs. Because if that particular value proposition is gone, so if you make any trade-offs to have short-term performance gains, that will then come at the expense of that censorship resistance. And over the long term, that is the only real differentiator that you have from all the systems you compete with.
Sure. And I guess as we're discussing this stuff, it's just making me think about proof of stake. Do you have any opinions on proof of stake?
It's an interesting topic, and I haven't actually spent too much time really diving into all these different, theories and especially different types of implementation. But the idea really is that we replace work by essentially the native endogenous currency or unit. It's a different threat and trust model that is involved as a result. So, and I think it's great to see some more research on this particular topic, because some systems could definitely benefit from a consensus algorithm like that, because they don't need to have the same level of trust minimization as Bitcoin. So I think Bitcoin is really one extreme. And then you've got other systems on the complete other or different extreme, which means that they are pretty much completely centralized. But so, and there's a plethora of different systems that are somewhere in between across that entire scale there. And this is perfectly fine. The thing is just you need to really be transparent when it comes to the trade-offs that you engage in order to achieve certain performance metrics, for example. And so proof of stake is really the problem I see with it is that it tries to position itself as an alternative, an equal alternative to proof of work with all the same benefits, but none of the downsides. And in life, there is pretty much no such thing as a free lunch, right? So you can't really just get all the positive aspects or properties of a given system or, component and just get rid of all the downsides. A particularly good example of that are enterprise blockchains. So the idea being that, Bitcoin, those systems, they are pretty interesting, but we don't like having our infrastructure run by some pseudonymous miners in China, and we don't like having some sort of unregulated token. So let's get rid of both of these. And the idea being that, okay, we keep all the benefits of Bitcoin without any of the costs or the things that we don't like. But guess what? In the end, you kind of like take the main innovation away, and you just end up with a rather slow and inefficient database management system, which can have its own uses in some, areas. But that's kind of like the same idea. And this is why I'm pretty skeptical about proof of stake, because I think there are definitely some hidden downsides that are not either not being properly disclosed right now or that we don't actually yet understand. And so just like positioning or portraying it as an equal alternative to proof of work, I think is a bit misleading. Whether that's done intentionally or not is a different question.
The upcoming Bitcoin 2019 conference is taking place on June 25th and 26th in San Francisco. There's an amazing lineup of speakers, and it's one of the most affordable Bitcoin conferences around. Go to bitcoin2019conference.com and claim a 25% discount with promo code BG25. That's bitcoin2019conference.com, promo code BG25.
Generally, people say, oh, Bitcoin is centralized or Ethereum is centralized. And then generally it boils down to, oh, well, yeah, mining is centralized. But what does that actually mean? Because there's not only one aspect to mining, there are actually several. So essentially, when you want to analyze whether a given, so the transaction processing, that's what we're talking about here. So whether transaction processing or mining is centralized in a given cryptocurrency, you actually have to look at three major types of concentration. And so the first one is really hardware manufacturing. So do you have specialized mining hardware equipment from different producers, or is there one company that monopolizes the manufacturing of a given specialized device? Then second, you have the hashing facilities, and two things actually. So first, is hashing concentrated in a geographical sense? So even if you have different operators of those hashing facilities, are they all based in the same country? And so that was really the case few years ago when really the vast majority of hashing was based in China. And so if they actually had decided to really clamp down on mining, that would have had a huge effect on the Bitcoin network as a whole. The good thing here is what we can observe so far is that it's geographically getting more and more distributed across all 5 world regions. But then you also have to look at the ownership of those hashing facilities. And so, of course, now, if you have geographic distribution, that's great. But if they're all controlled by the same entity, that kind of like defeats the entire point. And so from what we can see is that they're not like entirely well distributed. So there are some actors that have disproportionate hashing power and access to it. But still, for most of the cryptocurrencies that we analyzed, it doesn't look as bad as it's generally portrayed. And we see tendencies that actually there are more and more independent farms that actually emerge, which is great for hashing facility concentration in general. And then the third component to look at is the pool concentration. So hashers can contribute their hashing power to mining pools. And it's in the end, it's really the pool operators that hold the power as to what transactions to censor or to include in a certain block. Hashers can always monitor whether pool operators are behaving according to, their own preferences, ethics, whatever views. And if that's not the case, well, then they can quickly switch to another pool operator. Now, if you look at the pool distribution of the major crypto assets, you can see that it's actually really concentrated. So you have generally 3 to 4 mining pools for most crypto assets, or even less, that control more than 51% of the total hash power. Which might seem like those cryptocurrencies are completely centralized. But then again, as long as there are enough different hashers that connect to the same mining pool, and if switching costs are low, that they have the threat of essentially pointing the hash rate towards another pool, then I would say this is an acceptable situation, let's say. Although, of course, it would be great if things like Matt Corallo's new, I can't actually remember what's it called, Better Hash, I think.
Yeah, I've heard a little bit about that.
So making it easier for hashers to essentially build their own mining pools without necessarily losing too much in profits. So it's not as simple as saying, oh yeah, look at the mining pools to determine whether a cryptocurrency is decentralized or centralized. But you actually, if you want to just determine whether mining of a given cryptocurrency is centralized or not, you actually need to look at different components, which are at the very minimum, the mining hardware manufacturing, the actual hashing, so the facilities, and then third, the pool operators.
And I pay zero attention to proof of work mining outside of Bitcoin. You were saying some coins are more centralized than Bitcoin. Do you have any more details on that?
Yes. So the problem with other cryptocurrencies is that if they don't have specialized hardware, so a so-called application-specific hardware, that generally means that they can be mined with general purpose hardware, such as GPUs, is that the total existing hash rate might be orders of magnitude larger than what is actually being used to mine that coin. And that makes those coins really vulnerable, because at any point in time, you could have a very powerful botnet, for example, that would control millions of GPUs. If they decided to actually now 51% attack Ethereum, they could, in a whim, they could really just overtake the entire Ethereum network just like that. And then repurpose that hardware after crashing the price to, again, going back and doing some, gaming applications or whatever. Whereas in the case of application-specific hardware like SHA-256 ASICs, you can only use them for cryptocurrency mining for coins that actually use the same algorithm, so SHA-256. And so right now that's Bitcoin. Then you've got Bitcoin SV, Bitcoin ABC, I think, and some other forks. But Bitcoin has by far the lion's share of all that hashing power, which means that if you actually wanted to attack it, now you would need to either buy existing ASICs or you would need to create new ones. But you can't really take other equipment to actually mine it unless you, of course, have access to pretty much unlimited resources. And so when we look at most other cryptocurrencies, depending on the hashing algorithms they use, lots of them have implemented so-called Asic Resistance. And what this means is that they are all vulnerable to this particular type of attack. So if they are mineable by general purpose hardware, some outside attacker with significant resources and access to that general purpose hardware could at any point in time overtake the network very easily. And that is really the main problem that you have with lots of other cryptocurrencies. And then the other thing is, if you actually look at how much hashing power some of the top 20 cryptocurrencies according to market cap have, it's frankly ridiculous. It's beyond the joke, in the sense that for some cryptocurrency, it would cost less than $1,000 to actually 51% attack them for 1 or 2 hours. Whereas that particular currency or cryptocurrency has an estimated market cap, or allegedly a market cap of, let's say, $1 billion plus.
So I guess the perfect example would be the kind of recent Ethereum Classic double spend.
Exactly. Now, the thing is, why doesn't it happen with all these other top 30 coins that have still hundreds of millions of dollars in allegedly in market cap? Although it would cost less than $1,000 to actually successfully double spend transactions. And I've really been thinking quite a lot about this. I think the reason really lies, ironically, in the centralized exchanges that implement KYC and AML. In the sense that miners know, or at least, let's say, malicious miners that want to reorganize a chain to actually benefit from that, they actually know that they won't be able to liquidate those coins in time because the exchanges will coordinate and freeze those accounts, which means that they won't be actually able to profit from that double spend because their accounts will be frozen before they would be able to do so. That ironically leads really to the situation that pretty much 99% or even more of all the cryptocurrency would be very, very easily attackable, and the incentives would actually make sense to attack them. But they are ironically protected by the existence of those centralized exchanges that are required for attackers to actually cash out, because those exchanges would coordinate and actually freeze accounts.
The Bitcoin game is also sponsored by BTCKeychain.com, probably the most well-known Bitcoin keychains in the world. Get your own, just go to BTCKeychain.com. You said something interesting to talk about was Bitcoin's social contract. Was that something else? Because I had my assumptions what you meant by that.
What I mean by Bitcoin social contract, and again, I don't think actually the word contract is probably the best term, but it's kind of like social contract in the sense of, the philosophical sense of the term, that there's some sort of like implicit agreement between participants in a given system about the basic rules that they want to adhere to. It's kind of like a social construct, essentially. And so the idea really is that, okay, we've got a network now, that's a peer-to-peer network with independent nodes to kind of like send, information between each other and so on. Then we've got miners that actually incur some financial costs in the form of wasted electricity and running hardware. And that all runs on open source code. But now the thing is, why is one particular version of a code base worth a lot more than another? So for example, if I want to try and fork Bitcoin today, I can very easily do that. Now, I've got exactly the same parameters, exactly the same things as Bitcoin, but I now need to convince other people that my Bitcoin is a true Bitcoin. So what I want to say with that, it's probably not a very good way of explaining it, but what I want to say is that having a network, a code base, and miners is one thing. But actually, in the end, what really ties this entire system together is that shared belief in the rules that govern the system. And that is essentially what I like to call a social contract. And you have different constituencies, so different types of actors that run and operate and maintain this system, that have a system of checks and balances between each other, so that this social contract that everybody implicitly agrees with, somehow keeps working. So who are those constituencies? So there are different models for that, but generally it's the exchanges, you have the wallets, service providers, you have, of course, the miners. And as we mentioned before, there are different types of miners, right? So there are different subcategories for each of these. But then you also have developers, you also have the hodlers, you also have the merchants, then you have the payment processors. So there's like a whole bunch of different constituencies that all have somewhat different interests, but somehow kind of like agree on that sort of fragile social contract, which essentially is a way of coordinating all these different kind of like preferences of all these constituencies are somehow hold together in a very fragile equilibrium. And that equilibrium kind of like is maintained through systems of check and balances that each of these constituencies constantly checks on the other, that they respect that social contract. And now where it gets interesting is that if some constituency or subcategory of that constituency tries to suggest or implement a change, that is a change to the social contract. So if it's a change that will really impact the fundamental nature or property of the system. And then it gets really interesting, because then you can really see, and this is completely different from one cryptocurrency to another, how that governance process, so the way of changing or adapting that social contract, how that actually works. So in the case of Bitcoin, it's very clear is that the social contract is almost pretty much in stone. So there are a few key essential parts of it, like the 21 million coin limits and so on, that are not open to discussion. So anyone suggesting anything else is forking off and essentially creating their new social contract, which might be just a simple copy of Bitcoin's social contract with one minor change. But because the vast majority of the constituencies do not agree with that, essentially you fork off and you create your own social contract, which is a bit like nation states, if you like, that have their constitution. So the social contract is a bit like a constitution. And if some people don't really agree with that, at least like 200-300 years ago, well, what they did is they created their own country. So they kind of like forked the social contract and created their own constitution. And with that, their own country. So in the case of cryptocurrencies, the social contract is the constitution, and the system, the nation state, is essentially the system itself, the network.
It makes me wonder each time Bitcoin reaches a new major all-time high. I think the amount of new people dwarfs the amount of old people. And that makes me wonder, with enough new people getting involved in Bitcoin, if that allows for the social contract agreement construct to shift dramatically in the future.
That is exactly why it's so important that anyone can essentially have the ability to still run a full node. A lot of people say full nodes don't matter at all. And to some extent, that is correct in the sense that a full node only matters to you if you are actually verifying incoming transactions. So if somebody tries to pay you, you can be sure that you're not being paid with counterfeit coins. What do I mean by counterfeited coins? Well, exactly if somebody tries to fork the social contract, thereby creating a completely different system, they might be able to trick you into believing that their coins are essentially the real coins from that other system that you actually think you're using. But in the end, it's just a counterfeited coin. And so in order to be able to verify each incoming payment, you keep that independence to determine in a self-sovereign way, essentially, for yourself, which social contract you want to be part of. Now, if that ability is not given anymore because it becomes too difficult to run that full node, then you have to rely on somebody else to tell you what system you are actually on. So what social contract you are part of. And there's no way for you to verify whether that's actually the case or not. So then we rely on trusted third parties again that tell us this is the social contract and this is how it is. And then it becomes very easy for those trusted third parties to collude or get together and change that social contract, because there's no way or no ability for the users anymore to have a say in that. So essentially, if you are part of that social contract, you need to have a say in it by not only running a full node. Of course, there's different constituencies that have different ways of dealing with that, but to have a choice to be actively involved in all of that. And the problem is, there is no way of really determining what the majority really wants, because there is no way to determine what the majority actually is in the first place. Are we talking about developers? Are we talking about businesses? Are we talking about wallets? Are we talking about the number for nodes, which is pretty much meaningless? Are we talking about miners? If yes, what miners? The manufacturers, the hashers, the pool operators. So it's a very, very complex web of interconnected actors that share some interests. And this is why Bitcoin is actually so interesting, in the sense that the status quo is always the safest bet. So if you have some disagreement over some, fundamental issues, it is always safer for you as an individual or an entity to stick with the status quo, because that is the most likely to remain, rather than having some sort of change which require the majority of the constituencies to actually migrate to the new system. And again, the problem really is that we don't know how to determine the majority. And so when we get to, when we talk about Segway 2x and this entire, what some Bitcoiners, I guess, would call a coup by, large companies, it was really, really fascinating to see that a vocal minority, or a minority of very vocal Bitcoiners, essentially managed to overthrow that coup by essentially threatening to create a fork on their own. So that's all UASF was. And that was really interesting to see that a small minority of very, very vocal and dedicated Bitcoiners, and not even the economic majority, but a rather small number compared to like the total number of Bitcoin users, was able to actually stop that takeover attempt to redefine Bitcoin's social contract. And that is really something that has not been studied enough so far, and which is why we would really love to see more academics or scientists from, social sciences like anthropologists, well, even economists, sociologists, and so on, start studying those systems. And especially when it comes to these kind of like disagreements over the social contract, to better understand how those different constituencies and their opinions in the governance processes form. Because this is really something that we don't understand at all so far. And this, in my opinion, is the most fundamental thing of cryptocurrency at all. So I like to say that cryptocurrencies are not really technical systems, but they're rather socioeconomic systems, because the technology is essentially just using components that have been around for decades. But what's really the novelty is a combination of economic incentive design with game theory and the entire social component around this. So that coordination mechanism. It's not the math or not the hash rate and the proof of work that really determines the fate of a given cryptocurrency, but it's really the social contract around it. The fact that people collectively attribute value to a given system or given version or instance of a system, rather than one of its properties. And that is really fascinating to watch. And I would really love to understand a bit better how such a social contract first emerges in these decentralized systems, and then how it evolves over time, and the different constituencies, how they kind of like, relate to each other and so on. In the sense of Bitcoin, I would actually say that the fact that it's so difficult to change it is pretty much one of its biggest strengths, if not the key strength, because that makes its characteristics, like the 21 million coin limit, actually real. Because in Bitcoin, we can't even agree to increase the block size from 1 to 2 megabytes, I think you can pretty reasonably expect that it will be impossible to actually change that 21 million coin limit. And that means that essentially all those main characteristics of those systems are rather guaranteed through that social consensus that forms around those systems, rather than through really technical primitives. In the end, all those things, just like money, is a social construct. So kind of like a shared illusion, shared belief that if enough people actually think about it that way, then it just is.
Bitcoin kind of proved that something like Bitcoin can exist. And now all these other takeoffs on Bitcoin, all these other cryptocurrencies, well, if Bitcoin can do it, why couldn't these others? And then how much does that fracture the network effect? Do you believe there's cause for concern that too many of the next Bitcoins or the next Ethereums could prevent success in this whole arena?
No, I just think in the short term, it kind of like diverts a bit of intention. And as a result, also, funds and interest and develop activity to some of those other coins. But I think over the long term, it would become pretty clear that there's just like a bunch of them, really a handful, if any, that will be able to fulfill or preserve their main value proposition, which is censorship resistance. Because in the end, that is the only thing that those systems really have as a competitive advantage to their centralized counterparts. So in the case of Bitcoin, there would be payments. Now with Ethereum, there would be any kind of application platform and so on. So essentially every single property of your system is worse than your centralized counterpart, except for that one thing, which is censorship resistance. In order to differentiate yourself, you need to actually be censorship resistant, which only happens if you're sufficiently decentralized to actually provide that censorship resistance. In order to do that, that comes at really high costs. Again, there's no free lunch. And so we see it in Bitcoin with the insane replication and duplication when it comes to running nodes, storing the database and the ledger, in terms of the energy consumption, the mining that goes into all of this. It's just an insane replication, all just to make it very difficult for one single entity to gain control over the system. And you cannot replicate that waste, those inefficiencies, over thousands and thousands of different systems, because otherwise you just won't have enough resources to actually waste on running those systems, right? So I would argue it's really the inefficiencies that make those systems censorship resistant or decentralized in the first place, and as a result, censorship resistant. And now the problem is that there can only be, in my opinion, a handful in the long term that will be able to preserve that censorship resistance if they actually get seriously attacked. So if there is a dedicated actor, whether it's a state actor, whether a big corporation or somebody else, that is really dedicated to destroying a given network, I would actually say that this would be possible with 99.999% of crypto assets today, which means that we're pretty much left with less than a dozen systems. I would actually say maybe 2 or 3 that will be or are censorship resistant to a certain extent today. Which then means that all the other ones are right now just competing on some artificial properties that might, over the short term, put them in a better position compared to the applications that they're competing with right now. But over time, that advantage would just fade away, which then means that they have nothing to compete with because their only differentiator of the long term, so censorship resistance, is something that they don't actually have. But it's kind of like ironic because then you have, on the one hand, Maximus saying that, we don't want any intervention, nobody telling us what to do, and everybody needs to be self-sovereign and be able to take their own decisions and let the free market decide. But then if the free market decides to create thousands of coins, then suddenly that is something that cannot be and that we need to correct. I don't really think that we kind of need to take certain actions to disencourage the creation of those other coins. Apart, of course, from calling out obvious scams, just to say to protect investors.
Are there any other topics that you'd like to talk about?
One thing maybe that's worth also talking a little bit about is being your own bank or just being in control of your own coins. This is something that has been always one of the main value propositions of Bitcoin as well, if you keep your keys. Now, the problem is that the vast majority of people either don't want to be their own bank or are just for convenience purposes are not comfortable enough with that. And the same thing is true for institutions. So a lot of institutions do not even have the right to self-custody their own assets. And that's why we have all these custodians, among others, depending on one jurisdiction to another. And so what we can actually observe through our studies is that the vast majority of users are actually leaving all their coins at exchanges or custodial wallet service providers. And so some people say, well, this is a bad thing. But actually, I think it's not necessarily too bad in the sense that what I like about Bitcoin is that it gives you options. So everyone has the option to do whatever they want with their coins, to self-custody them, be their own bank, run their own full node, having to trust no one. Or the exact opposite is like just buying some coins and leaving them at an exchange and that's it. And frankly, both are fine. There are always different people with different preferences, different ideologies, and so on. Some just see it as some sort of investment, and why should you be bothered with securing that investment, especially if you have no clue about IT security? Whereas others really, from an ideological point of view, want to be as self-sovereign as possible. And Bitcoin enables both, and that's great, in my opinion. And also something that a lot of people tend to forget is that what has really helped most in terms of scaling, especially with Bitcoin, is really the emergence of all those custodial service providers that actually clear most of the transactions between their clients internally in their own database systems. Also, let's not forget that when I say custodial wallet service providers, that includes all centralized exchanges, because a lot of people are actually using them as a sort of wallet service as well. There are estimates that the multiple between off-chain trusted transactions and on-chain transactions is anything between 5 and 100x. And it's very difficult to actually get to the exact number. And it's something that we've tried to do with our research. Unfortunately, we haven't really gotten to that point yet. But that actually really shows that the number of on-chain transactions and the value transfer with that is literally nothing compared to what is being transferred or cleared in internal database systems on top of that. I actually think that those are rather, truly economic transactions, in the sense that this is really related to some sort of commerce trade or anything like that, rather than some of these on-chain transactions that are just, to collect dust or to do certain liquidity management things with your own wallets or just like spam others. Although I know a lot of Bitcoiners despise these custodial wallet service providers or custodial exchanges, let's not forget that they have actually contributed more to scaling than the Lightning Network and any on-chain optimizations taken together.
That makes sense. I guess there's a mixed bag with each thing.
So that's kind of like the summary, I suppose, of this entire conversation that we had. And also that really summarized our research pretty well, is that people always like to have, these very black and white, clear statements about, oh, it's like this, or no, it's like that. It's good or bad. So really binary statements. Now, the thing is, as a researcher, you actually need to tackle all of the different issues and aspects that are involved in that. And then you actually suddenly see, well, there's like lots of different shades of gray. And actually, there's so many different things to consider. It's very difficult to make a definite claim or statement. And then the problem is people lose interest in that because it's too balanced, too nuanced. They want to have those clear statements that they can either get behind or completely reject.
Looks like my heart out is going to be what ends this, because we could keep going forever. So let me ask you, are there any websites or social media accounts you want to direct people to?
I'm very active on Twitter. So that's at Rauchs, Rauchs. And then, of course, you can read all our reports and research at jbs.camac.uk/CCAF, which I'll probably better send you to put in the show notes. And that's pretty much it.
Thanks so much for your time, Michel.
Thank you very much. I really actually enjoyed this conversation.
Well, so did I.
Bitcoin.
Thanks for listening to episode 62 of The Bitcoin Game. Check out the show notes page at thebitcoingame.com for links related to my conversation with Michel, sponsor links, and other information about this podcast. See you next time.